Alright, back with another top 5 charts of the week. Missed the last couple of weeks because I was just flat out busy in the process of buying a house, so there's a lot going on right now. But we're back here and we'll start off straight into it with number one here, WTI crude oil breakdown. So we've got here the blue line is the 200-day moving average. Probably should have put a label there, but I think it looks pretty clear to those who are familiar with this indicator. Um, I mean, the obvious thing there is the breakdown between the, across the 200-day moving average. The other thing that's probably slightly less obvious is the double top there. I mean, it's not exactly the same, but that is a typical kind of double top pattern that you see. And, thinking about why that's relevant, it's basically a failure at a pretty much the same level, and then a breakdown through that little support level there as well. So sort of double significance there, and below that point it's kind of really open air until that sort of 40 to 50 zone. So I think that's a risk there. I mean, there's a whole bunch of headwinds to crude oil at this point. I talked about this in a report back at the start of October. You got negative seasonality, got stronger US dollar. There had been very, very stretched to the long side futures positioning. And then also the supply demand balance has, it's kind of swung back from, back during this sort of 2014, 15, 16 period here. It was a massive oversupply versus demand. And then that sort of swung back and corrected itself, but then now it's gone back the other way. So it's I don't know, like looks pretty bearish for crude oil at this point. We can always get some sort of geopolitical issue propping up, which might give it a bit of upside. But I think the downside here is compelling. And the issue with that is S&P 500 is sensitive to the oil price. It's because of all the energy stocks there. But I would note on that although it will still probably be a net negative, back in 2015-16, where the crash in oil, had a really big negative impact on the S&P 500 earnings at an aggregate level, the market cap weight of energy stocks was twice what it is now. So through that process of the oil price crashing, it caused energy stocks, the weighting in the S&P 500 from market cap base to drop in half. Same thing on earnings. So you could argue that it's going to be slightly less sensitive. But then the other thing is high yield credit. So high yield credit is actually really sensitive to commodities, and they've still. I'm not sure what the current weighting is, but remember I did a bit of work on it back in 15, and it was at one point it was almost 20% of high yield credit was energy companies. It's probably again it's going to be a bit lower than that now, but still a material amount. And if you think back to the start of this year, that spike in the VIX, we had that spike in the VIX, but we didn't have a spike in high yield credit. It kind of slept through it. I don't, now, if oil drops, fast enough and far enough, then that could cause high yield credit to awake from its slumber. And then, of course, oil price also has pretty key impact on break-evens, bond yields. Uh, it almost affects just about, well, it affects a lot of different asset classes. We'll just leave it at that, and we'll leave it at that. Number two, institutional investor confidence. This is quite a interesting index here. So we've got it in the red line. That black horizontal line there is 100, and so if it's below 100, then it means that institutional investors are reducing their allocations to equities or risky assets. It's from State Street's global custodian business there. It's basically State Street and I forget who the other one is, who basically own the global custodian business. So they've got like trillions and trillions and trillions of dollars. Pretty much, you think about the large fund managers, the money that they manage, they don't hold on to it. It sits in a custodian like State Street, and so if the fund managers are making all these changes to their portfolios, to their allocations, then State Street, through its custodian business, is going to know about it, and from that, using big data and all that, have made their own index here. And yeah, that's showing global investors cutting equity weights to lowest in 5 years, which is quite interesting. It's a bit of a weird, bit of an interesting indicator because it doesn't really seem to provide any consistent contrarian indicator or signal as such, but it's more of a sort of background context. What do I mean by that? Well, it did come off prior to the spike there, and then came back up as these guys were buying the dip. So, I mean, you could almost call it smart money, but then there's other times where it functions more like a contrarian indicator. So I think it's a piece of context to be mindful of. When it did start coming off from the peak there, that was like a month or two before this correction, so a little bit of smart money aspect to it there. I know usually when I see these indicators get to extremes, I tend to think that that probably is a contrarian signal. So one to tuck away in the back of your mind as things progress, as the rebound progresses, much as I would have expected. Now, number three of the last three, which are all sort of focused on emerging markets. Now, first one here is the manufacturing PMIs. So we've got developed and emerging, and the star of the show on this chart is emerging, where you've got a rebound in the October reading to a 5-month high. Now, the first thing to note is look at it. It's very choppy month to month, so there could just be another bit of noise. We could go back down further lower on the next reading, and there's probably actually a pretty good chance of that because the China PMI, all the other China PMIs have weakened off, whereas the one that goes into this actually rebounded slightly, which I don't think is the right signal as to what's really going on there. So, again, I mentioned in the article here that you really want to see it at least maintain, if not get a little bit stronger, to confirm that. But emerging market assets have been, beaten pretty severely this year. And if you get a turnaround in this little downward trend, this sort of slowing momentum, then there could be pretty key catalysts there. And sticking with the EM versus DM aspect, we've got here again EM versus DM average global economic policy uncertainty indexes. And these are sort of measure, as you might guess, economic policy uncertainty based on algorithms that read newspapers. And you can see there that the EM1 is diverging, which in and of itself is always an interesting thing, and spiking. Now, if you map these to equity markets, which I did in that article, these tend to work fairly well as contrarian indicators. Very much like the VIX, and in fact they move very similar to implied volatility indexes for reasons that you might expect. I mean, the kinds of words that are going to trigger off economic policy uncertainty reading or detecting algorithms are going to go crazy when you have some sort of volatility episode, just simply because the market's down, but also because probably something's gone wrong to make the market go down. Just like what we've had in the last few weeks with the trade war and midterms and all that sort of carry on. So I think that's kind of an interesting extra piece of sentiment information there, kind of contrarian signal there, and then that turnaround in the EM PMI. Then last one is a valuation lens for emerging markets versus the rest of global equity. So we've got really kind of like the three major chunks of global equities: emerging markets, USA, and developed markets excluding US. Equity risk premium, that's if you don't know what it is, I highly encourage you to go and do a bit of Googling and do a bit of homework on that, because it's a pretty interesting, useful indicator, and indeed a useful concept itself. So, rather than the mechanical calculation, learn a bit about the concept about it. But in terms of this, it's basically earnings yield minus inflation adjusted government bonds. It's basically uh, what investors, or the compensation that investors get for taking on equity risk. And from a valuation standpoint, obviously the higher the compensation is, the more attractive it is to hold equities, and vice versa. The lower the amount of compensation that you're being paid to take on equity risk, well, the greater chances are that you're going to be underpaid. And you always want to be overpaid, not underpaid, especially when you're talking about equity risk premium. And for emerging markets, it's actually slightly higher than what it got to in 2015, which is quite interesting because there was quite a troubling period for emerging markets then. And it's also materially higher than what it is for DM and US, particularly against US. So it's all looking really interesting for emerging markets at the moment. So I'll leave it there. If you've got any comments, questions, remarks, put them into the YouTube comment section below and subscribe to the channel.